trading into that gap again, and now that's the one that's going to go up. No. Mm-mm. But watch what it does. It does break below these lows here on that candlestick. And then the market trades back up into a bearish order block. This candle and that candle together, that is an area where inside that range, if the market can touch that area once more, treat it like the same way as trading into a fair value gap, like what I showed you on the 5-minute chart up here, that you're entering in there. This range right here, that's them getting in the last bit of opportunity in terms of timing where they can go short. I'm going to change that color. Give me a second here. And I'll change this because it needs to be different because it's bothering me. All right. So these up close candles, I don't really need that second one because now I can see that this one is shorter than that one. So this is the order block because this is inside the range of the previous up close candle. What is an order block? What is it? Because if you're listening to anybody else, they have no idea what the fucking order block is. Okay, it has nothing to do with timing sales. It doesn't have anything to do with a ladder or depth of market or DOM. It's DOM, not dome. It's the change in the state of liquidity. Okay, it's where you are in the marketplace and how it changes its delivery, where it pinpoints a very specific time. It's specific in elements that provide you a very unambiguous range in price, where if it can trade to it, think of it the same way you do with what I taught today with the fair value gap. If you're bullish and the market trades higher and trades back down into the fair value gap, you want to try to key up an entry with all things being equal and it's still bullish. The equilibrium price point, or if it's a fair value gap, it's the consequent encroachment, the halfway point. Or if it's a candlestick that makes an order block, the midpoint is mean threshold. It's expected to at least try to trade into it halfway. Those halfway points are important because if it can go to just half of it or fall short of half of it when you're bearish, or go down to half of it or trade just above halfway and then go higher, it indicates a signature in terms of strength of the move. It gives you that little bit of detail to say, okay, yeah, I'm not only am I on the right side of the marketplace, and it's probably going to start moving in my favor, but it's really going to move in my favor because it couldn't even trade to the midpoint. You see what I'm saying? It's a diametrically opposed contrast to what I was saying about stop hunts. You want to see a stop hunt where it goes against your direction, because then it really gives you the indication that it's going to move a lot, because now somebody has been unseated, and the only people that do that is the smart money. The smart money that will capitalize on someone else's missed opportunity, and then they ride the longer run higher or lower. Well, it's different when it comes to order blocks. You want to be able to see it not trade to the midpoint or mean threshold, but you allow for it. But your stop loss has to be outside the parameters of the order block. In this case, we have this up close candle here. Okay, if we can trade up into it, like in here where it does that, this range here, I'm going to throw a fib. I'm going to take this range off the box so that way you can see what I'm measuring here. This to here, that's the midpoint. Okay, or what? Mean threshold. Mean threshold measures at 17,678.75. Okay, so it's 8.75. What's the high of that candle right there? You're going to look at it right up here. Okay, what's the high of that candle? Holy shit! What's the chances of that? Right to the tick. 30 years, you're never going to not love it. It's still a beautiful thing to see. It's perfect. You can't get any better than that. Can you improve on that? Can anybody improve on that? Nobody can. But ask the Tom, Dick, and Harry's on YouTube teaching order blocks to show you that. Because they haven't. But this order block here, there's a certain caveat that needs to be applied to this. Okay? What is that? When I spoke earlier in the lecture, I taught volume imbalances. And what is a volume imbalance? A volume imbalance is any time frame where you have two candles immediately right next to each other. It's like this. Now these form with bullish price runs when it's buy side delivery, or bearish runs when it's sell side delivery. That means movement higher or lower. Taking the wicks out of the equation, because that's not what we're referring to when we're talking about volume imbalances. The volume imbalance is the difference between the candle that you're looking at and the one prior to it. Okay, so it's only a 2 candlestick or 2 time interval. That's a more specific way of defining it. 2 subsequent immediate candles or time intervals that have a measurement of the open or closing price that do not touch. See that? Now, if there's no wick, being shown in the delivery of the candlestick, or when the candlesticks paint on your chart, they, by theory, you can have a candlestick like this, where there's the highest high and the lowest low is the open and the close. It's rare, but it happens. But what we're looking for is the difference between the bodies. Okay. So if there's ever a separation between the two, like this, and the wicks can have this, like it could do, and it's not going to line up because it ain't going to line up. It's not going to be in the center of that, and I'm not going to monkey around with it. So the wick could come all the way down into this area here. So it could eventually be viewed as it's overlapping, and the wick on this candle could go all the way up to here. But my eye and I'm training you as a student to look at that separation between the bodies, because the majority of the volume of trading is done inside the body of the time frame that you're measuring. Okay, not numerically in terms of, okay, if you pull up a volume profile, I'm going to look and see there was more contracts traded here versus here, so he's full of shit. I'm talking about the volume of smart money's trading. See, they're not going in where you think they're going in at. They're going in where I'm teaching you they're going in at. I'm teaching you that. You don't know that. I'm behind a barrier where I can only go so far to explain certain things, and I can't go past that. And that pisses a lot of you off. And because I don't do that, and I won't do that, I'm labeled a scammer. But how many times are you watching me doing this stuff? On Twitter, we did it all the time. Every 1 minute candle being called out, explained what was going to happen. But this is a volume imbalance. So what you do is you have to incorporate this little range in price action. That has to be factored in your analysis. Now, that might act as one more instance where you can trade up into it, and then I can add another partial for a pyramided larger position. Or it could be it's going to trade up to that, and that's my exit. Or it could be I have to use this as that's my third PD array, and I'm bearish, so now I have to put a stop loss above this. So where would the stop loss need to be? It needs to be above the candlestick's high that forms this volume imbalance, which would be this candlestick right there. This candlestick need not be a swing high. It could be another high over here, and it wouldn't look like you would pick that candle. But it's the same framework I use for what? A fair value gap. So it shares similarities and characteristics for managing and employing it for entry, partials, and now I'm introducing how to use it for stop management. So if you're using this as an order block, there's nothing wrong with that, but you just can't just say, well, that's my one-trick pony and it answers everything for me. No. Your entry needs to be inside that candle's range, yes, but you also have to define the risk, because now you have a volume imbalance that's inside this candle here, right before this 2 consecutive candles, but we've learned that this is not important because this one's the entirety of the range. And let me say it slower and simpler. This up close candle is not relevant in terms of defining a order block this candle's high is above this candle's high. So we don't need to even refer to this. So that's why I measured that range with the box, showing you that up close candle is the order block. It does trade up into the volume imbalance, but that volume imbalance can do what? Remember what I taught on the lectures on Twitter? And remember what I taught on live sessions and lectures on the YouTube channel? Volume imbalances, you have to be what? Flexible. They can pass through them and be used multiple times. So because that is there, you have to define the risk with, okay, what's the candle that creates that volume imbalance? The high end of it. It's this candle. So your stop would have to be where? If you're going to use that as your entry, your stop has to be above this candle's high by one tick. So that would be 89, or I'm sorry, 88.50. Let me see what the high is. Yeah, 88.25 is the high, so 88.50. That's your stop loss. And your fill would be ideally using the opening price, which is 77.25. So about 10 handles. That's really small for NASDAQ. Like, that's really small. So that's why I taught in month 4. My old age is kicking in. I'm going to be 52 this year. I think it was month 4 in the mentorship. You can find it on the playlist in the YouTube channel, where I teach the PD array matrix. And I show you where all the PD arrays exist and how they nest together and what order they form. You do not see me introduce the volume imbalance in there. Why? Because the volume imbalance can appear and form anywhere in the spectrum of your dealing range. But they all are influential. So if you have a volume imbalance inside of your dealing range, in the time frame and time frame that you're trading off of, you have to extend them to the right because they will absolutely have an influence on price. And how do you use that? With managing a stop, you have to factor in the fact that, yeah, price should only go into that volume imbalance, but the rules for using it is you have to allow for static price action. Remember, it can color outside the lines, especially during high impact news driver days like today was. So your stop loss has to be here, okay? So I have literally given you a clinic today. I told you what was going to happen before it happened. I told you why it was going to happen. Told you the timing of it. Explained where the exact high of the session was going to be with that fair value gap on the 5-minute chart. Did it color outside the lines? Yes. Does that indicate or promote the idea that the concepts are flawed or don't work? Absolutely not. It was exactly what I outlined today. Exactly. And all you little piss ants that make these YouTube videos about me are stuck dealing with it. So let's go a little bit more in depth about order blocks, and then I got to get something because I'm fasted and I'm hungry and I need to eat. So let's get this business off. You're getting some extra credit here. I'm 20 minutes past myself. I was going to stay and leave at 10. No extra charge. All right, it's a 5-minute chart. Let's go into that. Alrighty then. Excuse me. All right, so now we have that fair value gap right here, okay? I want to say this, and then we're going to finish with this business here on our order blocks. But we have the fair value gap I pointed to live. Before it traded up into it, then I said, it's done. It doesn't need to do anything more. It's done enough for me. Now, if you're using that as your entry strategy, or if that's your model, okay, it overlaps with multiple things here. It overlaps with these consecutive up close candles prior to this rotation lower, and that shift in market structure below that low there. So you got to go back inside all this price action here. Where's your up close candle? You can't use just this one because you're not getting the full picture. Because if you're demanding it trades all the way back up to the low of that candle, you're going to miss trades. You're going to miss them. Okay. So how can you manage risk appropriately? How can you still engage the market using an order block correctly? And as its author, me, I can tell you right now, this is what you do. Okay. The up close candles that are in succession here, one after the other, that entire range has to be defined. That's one entire range. Now, you don't know, and I'm not going to be able to teach this part of it to you. So I give you the easiest low-hanging fruit objective on how to incorporate them in your trading. You may come away with this discussion today. So you know what? I've been waiting for more discussions about order blocks, and I'm not sold on the idea. I'm just going to stick with fair value gap, or I'm just going to stick with model 2022, or I'm going to stick with the silver bullet. That means that you're mature. That means that you have grown in your understanding and you practice what I preached in this lesson earlier. Don't let me influence you to do something outside of what you've grown comfortable doing and change something that already works for you, or undermine your development up to a certain point. Or if you're in a trade or if you're about to take a trade, don't let my expectations about the marketplace, because you don't know what I'm trying to trade for. You don't know what I'm aiming for. You don't know if that's just one entry point to a larger position size I'm going to build as it keeps moving in a particular manner. So because I'm not going to teach you or tell you what I'm doing with my trades, that's always going to be a factor. So don't let me ever influence your trades, ever. If you've done the homework, you've done the math on it, you're willing to take that risk, let the outcome be based on your management, your adherence to it, and your credit is deserved at the end of it, whether it be good or bad. And you can't say it's my fault that you made the money, and you certainly can't blame me when you don't make money. So this range here, we have the high and the low. Okay, that is your range for a bearish ICT order block. Okay, in that range, you grade it. So we have the up close. We're not measuring this low here. Why aren't you using that low, ICT? Because it's not an up close candle, and it's the time frame we're using here is the 5 minute. Why am I using the 5 minute chart? Because it's a high impact news driver day, and you're not allowed to trade with anything less than a 5 minute chart on a news impact event that's high impact. So in your economic calendar, you can use forexfactory.coms, you can use Econoday calendar, you can use anything else out there, okay? But it has to be something that's accurate. So those are the two I've used forever, and they'll serve you well. So this up close candle, that is the low end of your bearish order block, and then the high end is where the last up close candle, its high is, okay? And now we put the lower quadrant, the midpoint, which is mean threshold, and the upper quadrant in the high. In an ideal world, just like the same logic when I'm using my fair value gaps, okay? If I'm trading inside of a buy side imbalance or sell side inefficiency, the scope is the same, okay? Ideally, I want to see a sell form between the low and mean threshold. That's the ideal, if you want to call it, optimal area of entry inside a range that is an order block. If you are listening to Tom, Dick, and Harry's mentorship on YouTube or anywhere else, and they say the last up close candle is your order block, it's not always that. That's why I've been telling you all, you guys don't know what you're talking about. You don't know what you're talking about. You're learning today, and you'll be seeing all kinds of shit all over the internet now. But I told you I was going to come here teaching today. So this is where you want to be looking for your shorts. Can it trade all the way up here? Yep. What happens if you enter in here and it stops you out? You just took a trade prematurely, and you wait and see, does it give you more indication that it wants to go lower, but it needs to leave the premium side that makes this range. So if it goes up there, you're going to have to wait for it to make a low, break the low, and then the next inefficiency after that, because then you'll have what? A market structure shift inside the range that acts much like what? A dealing range. So your order block is what? It's a dealing range. But it's very specific with this part. What I'm about to show you right now, this is what makes an order block, okay? You're going to learn what this is today, and then anytime you see people putting shit up on Instagram or their mentorships, or you have the multi-level marketing boys trying to teach you what they think is an order block, they have no idea what they're talking about. We're going to take this range here from the low to the high. Halfway point, that little area here, that's a sweet spot. That's your point of where the best of the best entries are going to form. So in this range here, what do we have? Well, we have a breaker. That's in the lower area too, lower half of the order block range. We have the fair value gap here, the one I pinpointed to you before it happened. And we also have the optimal trade entry. How many things are there saying that this is going to go lower? Multiple, right? Any one of them could be your unique trading model. Is any one of them better than the other? No. No, none of them. None of them have any distinct advantage over the other. So, as I mentioned when I was teaching my paid students, when they come to the realization that all of my setups, that when I'm taking a trade, I don't just have one thing saying I'm taking that trade. See, some of you don't realize I'm answering the question that a lot of you have been asking me. Why did you pick that and not this? Because I have a confluence of the things that I use and can employ as a trader to get into a trade. I don't just have one of my tools saying this is a trade. I have multiple things saying this is a trade. See, when I first started, I was that insecure 20-year-old that had to prove himself. And I had to constantly give myself the assurance that I would have setups that can be trusted, because I hurt myself so many times trusting books and people I read about on the internet and tried to do certain things. And I tried to use indicators and those things hurt me. I put faith in things that were not really valuable. And I would beat myself up thinking that it was me that was doing it wrong when it was the underlying horseshit that I was trying to adhere to, when none of it works. There's such a thing as technical science, and you're seeing it today. We're talking about very specific elements that repeat every single day. Every single day they repeat. But you may not have the gearing mentally to try to trade the market in that direction. So that's why I tell you in the beginning, don't hold a bias, because you're going to be wrong most of the time in the beginning. What you want to see and study is every time there's a volume imbalance that forms. When a volume imbalance forms, mark it, note it. Remember the one I showed you here? Go back and listen to that time around 9:20 or so in the live stream. That small little volume imbalance formed, and I told you when it was trading, my eye is right there. I want to see how it behaves there. What did it do? It's overshot it by a little bit, and then boom. See that? That's experience. That's things that my eye jumps to. They're called signatures. Okay, that's a smart money concept that's being expected to behave a specific time in a manner in which the bias is deriving the outcome. It's directing the outcome, rather. So the things that you have to hold on to hardest and like wrap your arms around it, close your eyes, say, come hell or high water, until I'm proven wrong, I'm sticking with this. That's bias. That's what you frame with the market when it's not trading on the weekend. You either do that after Friday's close or before Sunday's opening. You have to come to your bias before then. If you can't come to a bias that you trust, don't trade on Mondays. Let Mondays frame the little nudge that you might need to get into a better favored outcome for bias. That way you can have a little bit more information. Be willing to let the Monday trade without you. Okay? So if you are utilizing this fair value gap here as the entry, as I was outlining today, that was the one I was focusing your attention on during the live stream, where would your stop have to be? Not this. You can't be this high. Some of you are like, oh, he's going to point. No. Go back and listen to the rules of the fair value gap. This is the candlestick that creates the high of the fair value gap. In other words, this candlestick's low is the high of the fair value gap. This candlestick's high is the high. I'm sorry. I think I said that wrong. This candlestick, let me widen it up. That candlestick's low is the high. It's the high watermark of that shaded area, which makes my fair value gap. This candlestick's high is the low of the fair value gap. So the candlestick that makes the barrier high in a bearish fair value gap, that candlestick's high plus 1 tick is your stop loss. Well, that's a lot of pips. I can't, or that's a lot of points. Well, whatever. Then don't take the trade. Or trade with smaller leverage. How's that for logic? But your protocol, when you're starting out like it was with mine, how much can I make? How much can I make? And how much do I have to trade to make that? And how much margin do I have to trade with? Versus how can I manage the risk, the mental anguish that it's going to put me through, because I don't have much experience when I'm first starting. So therefore I have to do what? Trade with the smallest of leverage. And don't look at that as a weakness. That is a strength. That's a strength. It's like when people join young men. And I did the same thing when I was younger. When I joined World Gym and I wanted to be like Lee Labrada. You know, I wanted to have a physique like him. And I was like, well, I'm gonna do the maximum weight. And I'm going to work out for 4 hours. And then I was sore for a week and I couldn't go back in the gym. But I thought that that's what had to be done. Big weights, long training sessions. No. When I did measured routines and I started eating more protein and doing all those other things, listening to lectures that are not getting to the point. See, y'all have TikTok mentality. You want shit given to you like that, and it's already 2 days late. And you wonder why you ain't making any money. You wonder why you can't do it. See, I'm a dinosaur. I'm a Gen Xer. We're the last generation the real generation, because we did shit that you all would melt in. We went through stuff. In trading, it's gonna be hard, and you have to have rules, and you have to only operate inside of these rules, these boundaries. And any results outside those boundaries should not be measured, because they are a direct reflection on you not fucking listening. You're doing things wrong. You're crossing the yellow line, driving too fast. And what's the recipe for that? Accidents, damage, death. And you think something's going to be different when you're trading? Somehow it's going to be different? No, it's not going to be any different. It's going to be fast and furious, and you're going to blow your account. And how fast can you go out and buy a new funded account? How fast can you refund an account if it's real funds? They should be weighing heavily on your initial actions as a developing student. So I've given you a lot here today. I taught you how to use the fair value gap and order blocks for managing risk, managing the entries. Where's the best entry strategy for using an order block? When do you use the last up close candle before the down move in price? If you're looking for a bearish order block, because some of you are probably thinking, I wish he would have said, I heard you. How the hell do you do that? I'm in your head. He's reading my mind. This is weird. All right, so we have a price run, okay, that may have a series of green candles or up close candles, because my up close candles are green. You'll have a series of up close and then maybe 1 or 2 down close candles, and then you'll have a down close candle right before your last up close candle. Okay, if there's a break in this, for instance, let's say this candlestick right here was a down close candle, or it would be a black candle for my charting, then I would have used that candle as my bearish order block, and none of this down here would have been a factor for it. How's that for simplicity? Real simple, isn't it? But if you ever have a series of immediate consecutive candles, you have to define the range that all of those candles make. Divide it in half, divide it in quarters, and the best setups are going to form below mean threshold, which is the middle of the entirety of the multiple candlesticks that make up my ICT bearish order block. So also the importance of, if you're buying down close candles and you're treating them as a bullish order block, you absolutely do not buy a down close candle that's outside of the range that just broke. Okay? Never do that. okay? Because you don't have the experience to know if that range being broken to the upside is going to be sustained. You don't want to do that. So what you want to focus on is this. I need the trend line thing here. After I say this, I'm done, okay? I'll give you extra, so you shouldn't be mad. Come on. All right, in terms of price, generically speaking, if you think this is the part that's important, okay? If you think that the market is likely to get up to, say, here, okay? Stop worrying about price right now. But ICT, you got your own charts. I'm teaching you something. If you believe the market's going to go up here, and we traded, and now we created a dealing range, and I've already defined how to determine a dealing range, but your bias says it's going to go up here, okay? In this run here, that's your dealing range. Splitting that in half, like that, where is the ideal entry points for a order block? Is it down here or up here? If you're watching this and pre-recorded and you're not live, pause the video and think about it before you answer it. Everybody here live, I'm forcing you to wait. All right, let's see here. That's about enough time. You want to see a down close candle in the upper portion of this range right here. So it would be like this. In that area, good grief. That's your area where you would look for a down close candle in here. Okay. Caveat. Now this is an amplification of the lesson of me teaching the PD array matrix. My students that paid me did not get this lesson. So you're getting something fresh right out of the oven. If there is a fair value gap on the time frame you're looking at, in this range, or the lower half, you do not buy a down close candle in the upper portion because it won't hold. It will drop down and reprice to the inefficiency that many times will have a order block associated with the fair value gap. Those two together will be confluence, and you're in a discount here. And then you can reasonably expect to see the market do that. Okay, so that's why it's important that you start with one PD array, learn it, but it's not going to stop there. You're going to need to know the PD array matrix, even if you don't use them as entries. Understanding what they are and how they form inside of a price run, it's part of the whole process of determining, why do I buy that down close candle and not that one? Why do you buy that fair value gap and not this thing? How are you able to pick this PD array and you ignored this over here? I just taught you today. See, there's certain things that are germane. They're salient points that are useful because they're my concepts. I know what I'm doing with them. You don't know what you're doing with them. You only have an introduction to them. But an introduction still is light years beyond the scope that retail stuff works. Far less than this will. This stuff it's finite. There's rules to it. Which support and resistance are you going to trade? Which support and resistance are you going to trade? How do you define your support if it's retail driven? What defines that for you? Everybody's going to have a different diagonal trend line. Everybody's going to have a different support or resistance level. unless we take our attention to everybody uses one time frame. It's the XYZ time frame. It's the 15-minute chart. It's the hourly chart. If all of us were forced to say, okay, by a show of hands or multiple choice or whatever, is this the support you would you use as your support for that time frame? And say we're looking at hypothetically a 15-minute time frame. If that's the case, and we're all forced to give our personal opinion about what is support and what is resistance, we'll probably have a closer clustering around one or two levels that would be predominantly viewed as support or resistance. But how many of you are trading off of a 15-minute chart? Not most of you. Most of you are looking at 1-minute charts because I've poisoned your mind thinking that the 1-minute chart is the answer to everything, and it's not. It's an answer to reduce risk and give you more entries, but more entries are not a requirement to do well. You want one good one, and that's what this over here teaches you. And it probably went right over your head. You're probably thinking, man, this is, what is he talking about? Right, but the people have been doing this for a while. They just had an epiphany right there. They're understanding now why their down closed candles they thought was a bullish order block went right through it and went lower, but still respected the dealing range. Didn't go lower than here. How do you know when to buy it down here and when to buy it up here? He's buying in a premium. Why is he buying in a premium? His video says, I just told you why and when.